Ladies and gentlemen, welcome back. It is March 21st. You got another Chart Talk coming your way. It's time to play my favorite game, Record Chart Talk Twice. Technical difficulties is like our middle name here at Trading Experts. But we got a very volatile market on our hands. Without further ado, let's jump right into the market outlook. So, market's been under pressure. It's no secret since about mid-November. Then we started seeing the harsh selling early January. And when things were looking most grim heading into last week, we closed at these lows, and we knew we had the Fed meeting coming, and charts were looking terrible. Everything was pointing to a market that is going to continue to flush. And what happens? The market rips higher, catches a lot of traders off guard. We did very well with it. There's a bunch of action in the Alpha Chat where traders made a great turnaround and really reacted well to the buying. We're seeing a lot of craziness in the market. I'm going to go through a couple things real quick. So you see the S&P here, huge rally off lows. I know you'll talk about the NASDAQ in a bit. NASDAQ ran 10% in 4 days. You don't really see that action too often. It's more typical of bear markets where we're seeing this hyper volatile action. But we take a look at the oil markets. They're looking like they're back on the rise. We got this Russia-Ukraine situation that's just putting those supply constraints even further on the oil market. So that's expected to, just keep inflation on the rise, which is not good for equity markets in the short term. I was looking at bonds today. The 20-year bonds, TLT, they're in the absolute dumpster. Then we look at the TNX, the 10-year Treasury, which we know has had an inverse relationship with most NASDAQ stocks, is absolutely on the rise. So we're seeing a lot of kind of backwards trading in the market where, relationships are not as obvious as they may once have been. We see the TNX, the 10-year rise like this. We saw the NASDAQ sell off viciously last year. We're not seeing that sort of thing going into this year. But we made a great turnaround last week. We'll talk about that in a bit. But Bennett, what are you seeing out there?
So the main thing, other than the things that you have gone over, of course now my chart just disappeared. We saw this, very obvious breakdown for the past few months, and I have like the NASDAQ pulled up. And of course, when it got the most obvious, where not even us, it was like anyone at least the people I was speaking with, it was like the market had to break down, we had to go lower. And of course, when the trend becomes that obvious, the market decides to do something else and change course. So we have successfully kind of left that breakdown stage in the market, and we're shifting over into now what might be a new base being formed. So for like the NASDAQ, 13,000 is like the line in the sand. That's like the key level support. And in my opinion, I think the 200-day will start to act as resistance in this new base or this new range, and that's 15,000. So you have like this 2,000 point range, and we're like dead smack in the middle of this range. So it's very hard to like start to put on risk when you're dead smack in the middle of the range. When we get closer to 15,000, that's when we want to like take some profits. And then we conversely pull back in, or if and when that happens, we want to be thinking to buy up off of support, not just blindly kind of chasing it on the way down. Because if it comes down to 13,000 again, it's more likely to roll over and break down lower. But it just seems overall that we're kind of shifting out of that breakdown and into more of a basing stage for most of the broad markets.
Yeah, I definitely agree with you there. Let's jump into some top ideas. All right, so this was trade of the week here. We're seeing oil back on the rise. So this CIVI integrated oil stock. This is just such a beautiful chart. Shouts out to Django for putting this in front of us. One, it has this beautiful macro flag. Two, we see the earnings early March. Love the earnings, huge growth, and now it's just tightening this daily flag up, into this tight little area between around this 50 and 59. 60 is a trigger here. It triggered on light volume off the open today. But it wasn't a real trigger. It was just off the open on some light trading. I love this one, 59.60 area. I think this one looks great for further gains, especially if we're seeing oil tick up once again. Then the number one chart I'm staring at is this DE. So we're looking for the market to pull in soon. This is not very sustainable action. Even if it's controlled pullback, even if it's sideways action, I really want to buy this deer on the pullback. We've seen these manufacturing and construction companies very strong. So if we see this pull back to 400, this is the top of my list for a pullback buy here. What else are we looking at? This This POR, it's a utilities name, and we don't gravitate towards these names so much because they're much more slow moving. They're not really active trading stocks. But with the action we've seen out of energy and utility names so far this year, it makes sense they're coming into favor. So what we're seeing here, we're seeing this huge move off lows. Now we're seeing a continuation pattern in the form of a flag. I would love for this to continue to go sideways before it makes its next move higher. But I'm watching this 55 area for the next leg, and I think that one looks really great. From that one, a very similar setup is the CACI. Huge move off lows, working on this continuation pattern here. The more sideways we get in this area, the better. We want to see these moving averages catch up. And then 302, 305, wherever we see that one start to bring in volume, I'd like to buy that one on strength. But again, if I'm buying these momentum trades on strength, I have to know that they're momentum trades. They're not these long-term swing trades. So I want to take profit as this name is moving higher into strength for a good portion of my position. From there, a couple semiconductors are setting up. This AMD, I'm not sure what to make of this just yet. And the reason I like it long is because of the move we saw in NVIDIA, where it had this similar downtrend and it broke the downtrend with some serious velocity and continued higher. So AMD's very similar name. It's kind of working on that pattern, this 115, 116-ish area. Now I'd love to see this go more sideways. I'm not sure if it'll give us that chance, but if semis want to continue higher, this is definitely one I want to be involved in. And a somewhat similar setup, same sector here, AVGO. So we see this ascending triangle set up, and it's getting to the top end of this range. So now what we like about it, if we zoom in a bit, we see it beginning to form an even tighter daily flag right in front of this resistance level. So we want to see this go sideways a bit more, and then eventually to that 615 area, that's where we look to get long. But I'd love to see this get drawn out and give us some more sideways action. And that's really it in a nutshell for things I'm looking at in the short term. Again, we're trying to take advantage of the short-term price movements. And right now, the S&P and the NASDAQ, they just made huge runs. NASDAQ was up 10% in 4 days. I'm not looking to put long risk on directly after that. I want to see either a pullback or digestion or sideways action, something of that sort to give us much more of a calculated entry. So I'll be looking for entries later in the week as opposed to looking, coming tomorrow and looking to hammer the keys. What are you looking at over there?
So I got a couple. First is HUBG, setting up through this 87 in time. We can see these higher pivot lows here, so we can see buyers are supporting the stock as it continues to kind of inch higher. We can see the first pivot 72, 76, 77. So we see these buyers stepping up. So it's eventually this pattern gets tighter and tighter. And then we look through 87 for the ideal entry for this blue sky breakout. You mentioned utilities before, this DUK. One of the members called out on the Monday morning call earlier this morning for this potential move up through this 108 area, another blue sky breakout on some tighter risk. You kind of buy it versus 104. We have this SSD, which has been very tight these last few days under this 120 level. And actually, after this chart talk, I'm going to throw a buy stop in just for kind of how tight it is. I'll be buying up through 120 versus 117, so I'll risk $3 in a $120+ stock. Very tight risk there, some decent volume, and that's it. Those are top ideas for me.
All right, I like those. And that DUK looked very similar to that POR, utility name, strong move off lows, consolidated little momentum flag forming. So I definitely like that one as well. Jump in some good trade, bad trade, huh?
Let's do it.
Let's start with the negatives. Let me give you my bad trade. So I was shorting this QQQ into the Fed. Let me go for an intraday chart. I'm going to bring up to 5 minute here. And so I'm not talking about this trade. This is a little scalp to the long side when I saw that downtrend break. That was a quick one. But I wanted to talk about my short into the Fed. So I was trying to be as vocal as I could be while I'm trading this. But, I'm trading off such a small time frame that I'm not really helping anyone out if I'm just saying, oh, I'm shorting here and I'm covering here 10 minutes later. So I did the best I could in talking about this, but I'll show you the one fatal flaw I made. So when the Fed was announced they were raising interest rates, my plan, if the market had popped into it like we had seen, was to get short for that move, that retracement move. So, the Fed comes out, and that's what this bar is on the high volume. So I get short a little bit, and it bounces, and I get short some more, so I have a full position. So then I cover 2/3 of my position right here into this 330. And again, I was trailing it on a very tight time frame. And my mistake was that I should have covered my entire position into this 329. Instead, I don't know what changes in my mind that all of a sudden now I need to see the market puke. First I was going to take advantage of a short-term move to the downside, and then I get in the trade, and all of a sudden I have this huge macro thesis on, the market's just going to puke this close, and we're going to be down 3%. When, that wasn't my thinking going into the trade. I was thinking we move lower and who knows how long, but I would take advantage of that short-term move. So the fatal mistake comes when I don't cover my position here. I hold 1/3 back, and now look what I'm doing. I'm adding to my short position until it pivots. So now I turn this nice green trade, nice very short-term trade where I was right. Now all of a sudden I change my thesis. I'm getting more short, and I have to cover when it starts breaking higher. So I turn the fat green trade into a small red trade, just overthinking it, trying to get a little greedy and things of that nature. So that was a big mistake on my end. So that was the bad trade for the week. Let's go into some of the good ones. Let me get this up. And this Regeneron's been my best trade all year. The one thing I've been trying to do a little better is get the most out of my trading ideas. I've been going to my stats a little harder this year, and I'm seeing how much money I'm leaving on the table in my best setups, and that was really taking away from my P&L because I was selling these things way too early before I got any signal to sell them. But I was like, all right, I'm up 2-1 or whatever I'm up, and it's been a tough year. I should just take my win. That's not going to make you any money trading. You have to wait for sell signals. Exiting is just as important as entering these trades. So this Regeneron, I was buying here in this flag 620-ish. I added to 626. I had a 10-point stop below that area, and I began taking some off here for $40, $50, $60. And what I really did well here is it's retesting highs, and it hasn't given me any huge signals to sell yet. But knowing what the market's done, knowing the Nasdaq ran 10% in 4 days, and we're due for some sort of a pullback, I had so much risk on that at that point I'm risking more P&L for if it does pull back on me. The risk wasn't making sense to hold on to that stock. So Thursday, Friday, and Monday, these are my biggest kicks, and I'm making 7 times what I'm risking for about 65-70% of my position. I can never be mad at that. So this one, if it does pull back, if it continues higher, whatever happens, I'm very happy with the way I traded this one. A couple other good ones I had was this CrowdStrike. Shouts to Heaven. So Heaven called this one out. We were looking at the cybersecurity names. This wasn't on my radar very strong, but I saw the positive action, and I was knowing internally I would love to have some risk on long cybersecurity, knowing everything that's going on in Russia, Ukraine, things like that. It's going to be a hot sector into this. So I buy this 192 area, and I almost have 2 trades going on. So I'm giving half my position just to this 186.50, and then I'm giving the other half down all the way down to this 177.50 area here. So I get the move in my favor, sick 2-day move, 192, and I'm taking off 205, 207. I took half my position off, and that was the position that I bought against 186.50. So I was buying $5.50 risk. I'm selling for, what is that, 192, 204, $12, $14. Some good risk reward on my side. And now if this wants to continue higher, I have the macro swing stock on my side. So you can see I kind of had almost 2 different trades going on, and it's able to, so I can take advantage of short-term moves as well as think longer term about the trade. And last but not least is this Juniper. I was telling the story in the last one. I'll tell it again here. Some bitchin' slippage on this one. So I had a buy stop through this 34.40 area for 8,000 shares, and I get 35 cents slippage. 34.40 turns into 34.75. 35 cents times 8,000. That's $3,000 just to get into position. So expensive slippage on my end. But I was taking some off into strength here. I still have a swing position on my hands, but again, the market's a little bit too feisty. I don't want to have a ton of fresh long risk in my active trading account. So I was comfortable taking profits in this one here. If it wants to pull back and pivot, I'm completely fine with that. If it wants to continue higher, I'm fine with that as well. So those are the ways we took advantage of the long side, or at least I did last week. What do you got going on over there?
So I didn't have any active trades from last week, but I was looking at 2 from the week prior that pretty where the hell they go? They were very similar to like your main point last week was where you mentioned it was like you had the good ideas with poor execution. It was like the overall theme from last week. And looking at some of my traits in the week prior, same thing. The idea was there. The idea was right. Execution was very poor. So for this BKNG, last week I watched this name pretty much pulling 30% off highs pretty much after earnings. I saw this little doji forming at lows where during this day, the low was 1800. It was turning back up through 1850. And it was like a very tight, low risk shot to buy low. We don't really try to catch the bottom, but just scanning the charts, and I just saw an opportunity to take advantage of it. And it ripped higher immediately, 150 points higher at the end of the day, and gapped up and continued higher, which was great. Now, the plan in this trade was to kind of catch a retracement, a 50% retracement of this drop. So, a move into 2200 was kind of like my ideal target in this name. But unfortunately, I prematurely raised the stop, and we were talking about this in the last one, too early in the day, and it pushed me out. And, had I just waited like I normally do, just waiting till later in the day to raise my stop, I could have potentially still been in this trade versus giving it away. And I still made money, and that's fine, but I just overly tried to execute and minimize risk too much that I gave away, a 20% trade when I only got, 5 or 6%. And same with this CTVA, again, tight risk entry, buying up to 53 with the trend, with the bull flag, versus the low a day. So I'm risking $1 in the trade, breaks out higher, closes amazing. And the next day we get this kind of like little blow off top doji at highs action. And it's like, all right, well, let me raise the stop versus that low. Because if it takes out that low, it's probably going to come back to 52 anyways. And then I'll just be back to break even. Obviously, that doesn't happen. It takes me out the following day. And now it looks amazing. And this thing probably just continues to drift higher because it's now at new all-time highs. And everyone who owns this stock is happy with it. No one is like trying to rush out of this name because everyone who owns it is staring at a green position unless they're short. So that was kind of like my, that was a good lesson learned for these two. Was just, the ideas were right, execution was very poor, and that was kind of the main lesson for me this past week.
Very nice. And trading these environments is tough, especially with the years we've had going on. But the great thing about it is how much it sharpens our skills. We don't have 100 winners every week, so now we have to really get the most out of every winner now, and it'll teach us such great lessons for when that market does give us that feisty bull run again. I can guarantee you we're going to be making a lot more money at the end when it's all said and done because we'll be getting so much out of our winners that it's going to this environment's going to be a blessing in disguise. I believe that in the deepest heart of my hearts.
Preach.
All right, with that, preach, baby.
Preach.
And with that, we can go book of the week. I'm reading this book called Noise, but I'm going to have Garrett edit my last reading into this one so that I don't have to talk about it again. Okay. I got that Noise book again. I started talking about this one like 5 weeks ago. I'm finally getting to the end of it. I just wanted to bring up one point that it brought forward, and it's talking about living and trading in an electronic finance world and, the different subsectors of the categories of traders, whether it be retail, whether it be institutions, or whether it be broker-dealers even. And it just brought this like very, very interesting point that I've never really thought about. And it's like if we look at a retail trader's trading screen, look like mine, I have charts everywhere. It's not going to look like what a institutional trader's screen will look like. And they'll have plenty more information or whatnot. And then you look at a broker-dealer's screen, and they're just matching orders. They can see who's getting an order on both sides. So if you take that equation further, and what the book really, the funny point it was like when you think about broker-dealer, don't forget like in a casino, they say the house always wins. And what are they called? The dealer. So everyone forgets that the second word of broker-dealer is dealer. So when retail trading, when you put in an order, what we think is that someone's taking the other side of that trade. That's not always true. So in institutional trading, if a hedge fund makes a trade, they're going to match that trade to another, a financial institution, a bank, whatever it may be. That's a direct, almost competition. What happens in retail trading, and we don't realize that, 90% of retail traders lose, the broker dealer, they're just taking those trades and they see where you're putting your orders. And now knowing that 90% of, retail traders lose, broker dealers aren't selling those trades to, other institutions, other financial houses, whatever it may be. They're just taking those trades because they can see both sides of the equation, whereas retail traders are just kind of trading blindly. So just seeing that was kind of just open up this kind of huge, I don't know, gap in the knowledge aspect that retail traders really have, and how much more difficult it is to trade, knowing that, you know, they see both of your orders and they're just taking your money as you chop yourself up or whatever the trade may be. But it really it just shined the light on how little of information retail traders have in the equation of, you know, institutional trading and broker dealers. I'm not talking about like, you know, some hot Twitter headline about getting news. You know, I'm talking about the actual mechanics and underworkings of the supply and demand of the market. You know, institutions and broker dealers are going to be able to see much more in depth where the demand is, when retail traders are really blind out there. And it made a lot more sense as to why retail traders lose money 90% of the time. So that was really it. I just thought it was really interesting. I never thought about it like that, and it makes me want to take way less trades. New rule is if I'm in front of the computer, no stops. I don't know if you remember back in the day, when we were at the trading firm, there's this like big scary ass Russian dude who traded in the back. He had like 15, 16 screens, and no one ever heard him talk. We would just hear him bang the desk or whatever at the day. And then one of our buddies once talked to him, and the only thing he ever said, he goes, "If you're in front of the screen, no stops." You know, and I wonder if it was, you know, because of that broker dealer relationship, if they're seeing your stops, they're just gonna run your stops. Almost similar to like the bucket houses of like the 1920s, when they would just like, you know, flash the market down 5-10% to get all these little guys out and make their own money. So now when I'm sitting in front of the computer, no stops.
I got the subtle art of not giving a fuck, which we know you already hate, or I know you hate it because you thought it was too millennial. But I'm only like 30 pages in, so I don't have like a really good read on the book. But there have been a couple quotes in the book that I think are very relevant to trading. So I have a little bias and I like it, where I know you didn't. But one of the quotes was pain and loss are inevitable, and we should let go of trying to resist them. And I think that relates to probably the last few months of the market, where as the market has dropped, and we did overall a very good job for most of the guys in the group and girls sitting on the sideline and not doing much. But there could be those times that frustration comes out of, you know, I want the market to be, you know, to come back. I want to look for setups. I want to put risk on, and you can't. You have to just let the market do what it wants to do. You can't try to resist it or say, you know, it should be going higher because I think whatever my thoughts are. So again, I haven't finished it yet. I'm only, you know, kind of a tenth of the way into it, but I kind of like it so far just because there have been a couple decent quotes in it so far.
Okay. All right, and with that,
I think hopefully we recorded it this time.
With that, folks, that's all we got for you. See you next week.